If you remember, we've taken a look at the idea of a commercial bank, and a commercial bank is simply business in town. I know in Fort Collins we have many of them where people like you and I, called customers or consumers, can go purchase their goods and services. It's just a bit different. You're not really used to what it is that they do more often, because when you think of, let's say, Chipotle, you go in and you buy a burrito and you leave with your burrito consumed and you're quite happy. In this case, what we're doing is we're buying from the bank a good of protecting our money. We're depositing our money at the bank. And it's a bit strange because the bank itself pays us to do that with a certain interest rate on our savings and or on our checking accounts. So let's talk a little more about that today. So let's just say that person A, there we are, finds a Benjamin, a nice $100 bill somewhere on the ground, and they decide that they are going to purchase it or deposit it in the bank. So they head off to the bank with their $100, and their $100 goes into the bank with person A, and out comes person A, who's no longer holding on to their $100. So what exactly do they have? Well, they have a receipt. In this case, a checkable deposit slip, and this says that they have ownership and entitlement to $100. It is just located at the bank. Person A is still happy. They feel good. They have $100 and they have access to their $100. In many cases, they'll put in a checking account. They carry their debit card with them. And instead of using an actual bill or $101 bills, the debit card themselves is just keeping track of it electronically. Well, what about from the bank's perspective? Well, I think we have to once again remember what a bank is. A bank is a business, as we discussed in our last class. Businesses sell goods and services in the product market to the households. And the bank attempts, of course, to make a profit. And the profit is good. One more time, hear my voice. In a system of capitalism, or what you and I call the market economy, I'm going to keep re-emphasizing this. Ceteris paribus, profit is a good thing. So exactly what is one way, which is the point of our discussion today, that a bank can bring in revenue to increase their profits? It is to sell something called a loan. And what is a loan? A loan is where a person who does not have enough money heads to a bank and borrows money to buy that particular good or service. In exchange, they will pay the bank back how much money they borrowed, plus the cost, time, that the bank is missing, opportunity cost, of the money itself. It's called an interest rate. So when it's all said and done, your loan will be the amount you borrowed, the principal, plus all the interest that you have paid in the process. For those of you know who Dave Ramsey is, Dave Ramsey encourages you, never take out a loan, only buy goods and services that you can directly afford through your labor. So the question now becomes is exactly how much can a bank loan out? Well, the bank is subject to the rules of the bank. And once again, who is the bank? That is the Fed, the Board of Governors of the Federal Reserve System. The Fed is the bank for commercial banks. And once again, if you live in Colorado, our particular districts, and the Fed is located in Kansas City. If you remember from a previous lecture, the Fed and the government have in place what is called a reserve ratio, and they are the ones that control this. And the reserve ratio simply tells a bank that for every dollar that is deposited by a depositor, which is called a checkable deposit, it is a liability to the bank, because those who deposit their money, you and I, have a claim on that money. They must put aside some of it But the rest of it, they can choose to do what they would like to do. Let's hypothetically pick out a number. Let's pick out 20%. That means for every dollar that I deposit at the bank must keep in their vault or at the Fed 20 cents. The rest of that, they have options. So one more time, let's take that $100 that was deposited in the bank. According to the reserve ratio, the bank must keep on hand what are called required reserves. Once again, in their actual vault or in the building of the Fed. In this case, required reserves are 20%. The bank has no choice. It must keep on hand exactly $20, which is 20% of the deposit made. Now, they could keep more than 20, but this is no doubt they cannot dip below 20 or they would run afoul of the law. And of course, a bank would not want to do that. It would be a bad reputation, and depositors would not be prone to use the services of banks, which have a bad reputation. I remind you, competition is what regulates businesses in a system of capitalism. Consumers will hear about who does a good job, who does a bad job, and we will always flock to those who do a better job, ceteris paribus. So what about the remaining money? Well, how much was that remaining money, of course, is a question you should be asking yourself. Well, it's $80. $80 to a bank is called excess reserves. So every amount of money deposited, a bank puts some aside into the required reserves according to the reserve ratio. Anything left over is simply called excess reserves. So what do they do with this money? That is a great question. Well, let's now think about the United States of America and all these people and take a look at the process. Person A finds that $100 or his gammy gives them the $100. They go to the bank and they deposit the bank. One more time, person A heads into the bank, deposits the money, comes out, and what do they have? They most definitely have a deposit slip that says they have a claim and ownership of $100. This slip right here directly relates to the Benjamin that we put into the bank. But along comes person B. Person B is looking to buy something, just don't have enough money. So person B heads into the bank, says blah, 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 blah. I'd like to borrow some money. Bank takes a look at them, finds them to be a trustworthy risk. Remember, every loan is a risk to the bank. And out walks person B. Well, what do they have is the question. Well, what they have is a loan form they filled out in a slip that the bank has agreed and has created for them or give them an actual check, not actual money. Make sure you understand that. A check or opened up an electronic account that says they have $80. That's perfect because that's exactly how much person B wanted. They wanted to buy themselves some new overpriced shoes, which I recognize you guys do love your overpriced shoes. Interesting. So that is the process of a loan. Well, what does it mean to us, the economists? Let's take a look at the United States of America again. The bank is known as the Fed. The banks are known as the fractional reserve banking systems themselves. And what happens is that this bank, this money is being deposited by one person. I'm going to call person A, and it's $100. And then person B is going to the bank, and out they are coming with $80. So one more time. Person A, notice the direction of that arrow right there. It's most important for you guys to understand. The money is going to the bank. Person A goes to the bank with the money. Person B goes to the bank with nothing and walks out with money. Person A believes they have $100 because they do. Person B believes they have $80 because they do. What exactly does this mean? Well, from an economist's point of view, we're talking about the overall supply of money and the thousands and thousands of people who deposit money in the bank, and the thousands and thousands and thousands of people who take loans from a bank. Loans for what? Well, typically you might take a loan at your age for a car. Your parents might have loans for their houses. Your parents might have loans for boats. If you're lucky, my advice, don't buy a boat, just have a friend who has a boat. And I think many of you are going to take out loans from some entity, whether it's a private loan from a commercial bank, or many of you are going to take loans from the federal government. We'll talk about that. The most important thing to understand is really this. Number one, person A is a depositor. They actually had $100. Make sure you understand that. Person B, on the other hand, took out a loan for $80. When we look at the overall supply of money, we notice that together there is now $180 in the overall economy. Let that think in and make sure you understand. Person A went to the bank with $100. Person B went to the bank with nothing and walks out with $80. Person A has money. Person B has money. That's the total supply of money. Person A had money and still has money. Person B had nothing and all of a sudden they have money. The money supply. What has just happened? This is the most important thing, and I will elaborate this on the next discussion we have. $100. Poof! Magically became $180. Who did that? Who is this entity that magically waves their wand and poof, money comes out of thin air? Ladies and gentlemen, it is not anybody who attempts to do that. It is just what happens as a direct result of what is called a fractional reserve banking system, where there are depositors and there are loans. And apparently the process of loans create money out of thin air. Interesting.